Assalamu alaikum wa rahmatullahi wa barakatuh, dear brothers and sisters. This is the third part of the topic of materiality and risk. This part we will discuss the risk of audit, and we will define it. We will discuss also the type of audit risk and see the factors that affecting the audit risk. Let's move on. Okay, so we are in learning objective 5, defining the audit risk or risk in auditing. Defining the audit risk. First, audit risk is the risk that financial statements are materially incorrect or materially misstated, even though the auditor opinion stated that they are free of any material misstatement. Means the auditor issue wrong audit opinion, and it is risky when the auditor give opinion that the financial statement is clean and representing free view, and it is representing the financial position of the company, whereby in reality the financial statement is carrying material misstatement and errors. As we know, the purpose of audit is to reduce audit risk to an appropriately low level through the adequate testing and sufficient evidence. So how to ensure or how to mitigate or reduce the audit risk is to increase or set up the adequate testing and sufficient evidence. When to do that? It is in the planning and setting of the audit program. According to ISA 240, audit risk is the risk that the auditor may unknowingly fail to appropriately modify the opinion on financial statements that are materially misstated. Means the financial statement is carrying some material misstatement, but the auditor give an appropriate audit opinion to that financial statement. So that is the risk definition by the ISA 240. Okay, so to illustrate what we have just discussed now, we will say now what is the audit risk, how risky, because we have two types of errors. Yeah, auditor may give wrong opinion, but sometimes wrong opinion maybe the financial statement is not carrying any misstated, any material statement, but the auditor still give them qualified opinion, which is that the financial statement is not true unfair, carrying true unfair view. So in that case, yeah, it's wrong opinion, but it's carry less risk to the audit compared to the giving unqualified opinion or clean opinion, whereby the financial statement is carrying what we call material misstatement. So let's say if the financial we have two scenarios. The financial statement is materially misstated. The auditor issue qualified audit opinion. So in this case is the financial statement or the client company is deserved to have qualified audit opinion. How about if the financial statement not carrying any material misstatement? So in this case, they deserve to get unqualified audit opinion or clean opinion. Okay, so that is the norm. This is the correct audit report issue. So the risk is when the financial statement is carrying material misstatements and the auditor give them unqualified opinion. Okay, and the other risk, which is less risk, when the financial statement not materially misstated, but we give them qualified audit opinion. In this case, why we make it less risk, why we put it in a dot arrow, the reason for the first scenario, when financial statement is materially misstated and we give them unqualified opinion, the users of the financial statement will be harmed, will negatively affected their decision of dealing with the company and so on. They will carry on, they will provide the company with loan based on the auditor opinion, which give them some confidence, which is not real, which is not correct. So the suppliers will keep giving on credit. The customers will still deal with this company, and also the bankers will still supply loans to the company. Also, the government will mislead with this opinion. So it will carry all of those parties, business parties who is related to the company, carry wrong perception and mislead them, which in the end will lead to sue them the auditor. It is risk because it risks the audit profession. Whereby in the second scenario, if we give them qualified audit opinion, whereby the financial statement has no material misstated, the auditor, the client company, they can object and apply for ask for different audit opinion from another companies, which they can carry, and they can sue the auditor actually, but it's not that carrying damage for several parties compared to the first one. Okay, to discuss and to understand the audit risk, we should know that the risk is come from the risk of wrong opinion or wrong audit opinion comes from the wrong test, wrong audit test. And we know that we discuss in early chapters that we have two types of tests, test of control and substantive test. So we will have the same thing or the same risk here. So the first, we have two types of risk related to test of control. The first one or the type 1 risk is the risk the auditor conclude that the control risk is greater than what is actual, and meaning that the auditor say that the control risk or the internal control is not effective and weak internal control system in this client company, whereby in reality the internal control is much better in from what the auditor assess and view. So in that case, the auditor will drive to do more substantive tests. So it will drive to a type 1 risk related to substantive test, which the risk auditor concludes that material errors existed when it does not. So it will drive the auditor, when they do the substantive test, they found that the auditor conclude that material errors or material misstatement is existed where it does not. In this case, so we can the auditor may conclude or may drive to wrong audit opinion. We will discuss it in the second slide. Okay, so type 2 of risk related to test of control, that the risk of assessing control risk too low. So we assess the control risk very low, whereby in reality the internal control is not effective and very weak, but we say the internal control is effective and good. So the assessment of internal control risk is, we set it up as low. So in that case, it will drive to less substantive test. So substantive test type 2 risk drives to the risk that auditor concludes that the material errors is not existed, where it is in reality or actually it is there. So in this case, it will drive to wrong opinion. So in the next slide, we will explain how this type of risk will reflected to the auditor opinion. Audit risk and evidence. So if we can recall that when we discussed in previous topics about the audit, the control risk, and we discussed the assessing of the risk, and one of it is we need to understand the auditor required to gain an understanding of the client business and industry and assess the client business risk. So by having that understanding about the client and industry, the auditor will be able to assess the inherent risk and also the internal control system risk, which we will discuss it in details later on. Even though for the internal control risk, we already discussed it in details in separate chapter, I think chapter 10, which we discussed it in early time. So the auditor used the audit risk model to further identify the potential for misstatement and where they are most likely to occur, meaning that the auditor will try by using the model in the planning stage of auditing process to identify the potential and the likelihood of the misstatement and which one of the account of financial statement is more likely to be risky and misstatement may occur, material misstatement may happen more likely compared to less likely happening with other accounts. So the auditor will apply the audit risk. Here we will discuss the different type of risk. So we have client business risk, and we have also financial reporting risk, and we have the audit business risk and engagement. We will discuss it in details after a while, but let me give you some hints here. So client business risk, it means the risk related to the nature of the business, to the nature of the account. So in some business, it's more riskier compared to other companies. So company dealing or selling gold, they have more risk compared to the companies dealing with selling food. So it, in terms of the value and in terms of the risk that they may face. Also related to the account that they handle. So the company with complex transactions and complex accounting method to use is more risky compared to the risk to the companies dealing with traditional transaction of selling and buying. Okay, so that is related to the client business risk. And then financial reporting risk, which means the risk of what we call material misstatement on the financial statement. So we will discuss that in details. Number 3 is audit business risk and engagement risk. Audit business risk related to the business of the audit CPFM, of losing the license, of having less experience, staff and team of audit, and as well as of the low fees collected or getting low fees from the client. engagement risk related to the engagement process risk. So we will discuss that. Why we mentioned those type of three risks that will shape the component of audit risk model, which is inherent risk, control risk, and deduction risk. When we say inherent risk and control risk, which is related to the client business, so inherent risk and control risk, auditor will assess how risky is the business of the client, and also auditor will assess the effectiveness of control system, internal control system, and will assess whether it is very risky or low risky. Okay, deduction risk, which is related to the auditor business process or auditing process. So normally the deduction risk will set up as low as much as possible, because auditor will not accept to have high risk of deduction. A deduction risk means the auditor failed to deduct the material misstatement on the financial statement and the process of collecting evidence. And we have two types of deduction risk: sampling risk and non-sampling risk. When we say sampling risk, means the auditor failed to, when they set up the sample is not representing the population of the transactions and accounts. Means the auditor wrongly select the sample that not including the material misstatement. Okay, so in that case we will call it sampling risk. It's related to the sampling method and size. If not sampling risk, then it is related to non-sampling risk, which is, it means the auditor has been able to set up as appropriate sample representing the population, whereby they feel the auditor failed to deduct the risk within the sample due to several reasons, maybe the lack of experience, lack of time and effort in deduction the risk within the sample. The first type of risk is client business risk. And client business risk is the risk that the client will fail to achieve its objective. Means it is the obstacles that the client business may face to avoid them to achieving their objective. And we have explained this in details in previous chapters, so I will not go in details, but it is more related to the inherent risk. So client business risk, what is the auditor premium concern here is to assess the material misstatement in the financial statement due to the client business risk, which is the inherent risk that the auditor concern. So auditor concern here is to ensure that the assessment process of material misstatement in the financial statement due to the client business risk is appropriate and correct. So I put here some definition of the client business risk. You read it in your own, because we discuss this one in a separate chapter early. Okay, this one also. So in order to properly judge the fair presentation of financial statement, auditor need to understand the entity's business strategy, risks, and its ability to respond to the changing environment. So that's the auditor responsibility. If we notice that the auditor responsibility or role is related to the financial statement, always we link the auditor role to the financial statement risk. Under the client business risk, we also have two types or two levels of the risk, in level of industry and also in level of the entity itself. So when auditor, when he or she assess the risk related to the business, they need to assess the risk related to the industry as a whole, and also assess the risk related to the entity itself. So by failing to assess this risk related to the entity and the industry, that may affect the going concern concept. So we need to, what we mean by risk analysis of business as going concern means the company, there are some factors or something happen within the business industry or within the company transactions and occasions may affect the going concern situation of the company. The indication that the auditor need to give attention to is the bankruptcy of debtors of the business, means the company dealing with some customers, and some of these customers are announcing bankruptcy. So in that case, especially if that one of the big customer or the loss of major customer which is unable to get replaced. So in that case, the auditor will need to give to assess that risk and put it in mind. Another example is the patent or the key license is expired or has been lost. Mean the license or the ingredients or license of production, or if there is any various legal charge against the company. As part of the client business risk is the inherent risk, as we said and explained just now. So some factor that may affect the inherent risk is the nature of the business, and we discussed this, the nature of the business. If different nature of business may carry different level of inherent risk. Related parties means that who's this related parties in terms of suppliers or the customers or the banks and so on, all of these related parties and how they are risky to the business. And then we will have also the external economic factors that related to the tax, related to the any regulations, penalties, the custom rules, and so on. All of that is external economic factors. Even part of it is the loan interest rate. Non-routine transaction means that if there is any non-routine transaction, like it happened occasionally, normally the normal transaction with this is local transaction. Suddenly we have international transaction with customers abroad, and this transaction carry a lot of amount or risk. So that is non-routine transaction. Audit history. The auditor, from the history of auditing the same client for last year, he set up certain risk that related to certain account or certain account segment. So that is also may affect the inherent risk. Then judgmental requirement, correctly record the account balance and transaction, like the depreciation and so on. Then factors related to the fraudulent. So if there is any fraudulent suspicion by the auditor, suspected by the auditor, so that will affect also the inherent risk. The second type of risk here we will discuss is about the financial reporting risk. So it is related to the recording of transaction and financial information presented and included in the financial statements. So any risk related to wrong information or recording of transaction in the financial statement, that we can call it the financial report. So here we will discuss the inherent risk examples of financial statements or financial reporting. Examples: non-routine transaction like selling or disposal of some assets or machines. Complexity of organization structure. Assessment, assumption or judgment based accounting. So that's kind of inherent risk related to the financial statement. Business relation and frequent meeting of the board of directors, and human intervention, mean the interruption of the human risk. So what's the factors affecting the financial reporting risk? First is the company financial healthy, the company financial health. So if the company is facing stress, financial stress, then we expect that the financial reporting will be more risky due to the intention to manipulate or overestimate the financial statement. Also, the quality of internal control. The effective internal control, the less financial reporting risk. The complexity of transaction and financial reporting system. So the more complex, the more risk we expect in the financial reporting process. Lastly is the management integrity. If we experience that the management have lack of integrity and they intend to manipulate the figures in the financial statement in the history of auditing, then we expect to have more risky financial reporting. Okay. For financial reporting risk, if it is high and the auditor can assess or identify that the financial report risk is very high, so it is expected that the financial statement will carry high fraudulent or financial fraudulent or errors. So in that case, the auditor may rethink about the engagement, accepting the engagement with this client. Third type of risk is audit business risk. Audit business risk or engagement risk is the exposure to lose or injury or harm the professional practice from litigation, adverse publicity, or other event that may come due to the connection with the financial statement audited and reported on. Means any harm to the audit process, business risk that may come due to auditing and providing wrong audit opinion, and that risk may come in a form of drawing the lesson or phrasing the lesson, or sometimes suing the auditor in court case. The impact of engagement risk on acceptable audit risk. So in the initial stage of auditing process, the auditor will decide and plan the engagement risk and use that assessment risk to modify the acceptable audit risk. The engagement risk is closely related to the client business risk. As you remember, the client business risk is related to the nature of the business, which is the inherent risk, and related also to to the internal control risk assessment. So if the inherent risk and control risk is very high, then the engagement risk will be also very high. And in that case, the auditor will raise the question whether this the financial statement of this client is auditable or not. So in that case, it's really we can link the engagement risk into the financial reporting risk, which we discussed it in the early slide, and I link it with the engagement, whether we accept or decline or refuse the continue to audit this client. Deduction risk, as we defined it early, deduction risk is the auditor failure on deducting the material misstatement on financial statement. So if that happens, there are two reasons or two types of the deduction risk, either to be due to the wrong sampling, which is we can refer to sampling risk or non-sampling risk. If sampling risk means it is about the wrong sample that not reflecting or representing the population, so that will drive to wrong opinion. Let me illustrate this one more. So imagine we have this population of 4 transaction. So one of this transaction, let's say this one is this one, the with red color, the X with red color is the transaction carrying material misstatement. So the wrong opinion related to the sampling that we select the sample that not including the misstatement or the material misstatement. So in this case, we will have deduction risk related to the sampling. It is because we did not include the sample within our we didn't include the appropriate or the representing sampling for the population. So in this case, we call it sampling risk. So if we include it, let's say we did include it with the sample, and we fail to recognize it due to the mistake of test or lack of experience, or due to the lack of time, we didn't do a proper testing, audit testing, and we cannot deduct that material misstatement, even it is part of the sample. So in that case, we call it non-sampling risk. Okay. To conclude, there are 3 main components of audit risk model. So the first one is inherent risk, control risk, and those are representing the RMM or the risk of material misstatement in the financial statement, which is risk of financial reporting, what we have discussed. And then we have the deduction risk, and deduction risk is related to the process of deducting and deducting the misstatement that we have, the material misstatement. And we have discussed that the deduction risk is have 2 groups. One is related to the sampling risk and non-sampling risk. So that is the inherent risk and control risk, deduction risk that are representing the audit risk model. We will discuss it in next part. So this is the 3 component of the audit risk model. So inherent risk means the material misstatement would occur in the absence of internal control in the business. Means the inherent risk may be due to the nature of the business or other component inherent into the business type or the account type. So control risk is the material misstatement is not deducted by the internal control system on timely basis. So, and also the deduction risk by the auditor is the risk that the auditor will not deduct the material misstatement in the financial statement, and if we have that, then we have the audit risk. To have better understanding of the component of the audit risk model, so let's say that the auditor identify and assess the inherent risk and find that there is some material errors at all. So they found it. So if the auditor find it, the auditor will expect that the internal control is set up to mitigate and reduce or eliminate that inherent risk. So the next question the auditor will ask is that if the internal control is effective, which is there any we imagine that this is the net of the internal control, and try to avoid these blocks to go through. So if any of these blocks go through, then we will that is the control risk. So if these blocks being caught by the controls, then the internal control is effective. If no, then we have the second or the third layer of deduction, of control of avoiding the risk, audit risk, which is deduction risk by the auditor. So the auditor process or the audit process we should quote and deduct that risk. If the auditor fail to deduct those risks of financial statement, then that is the audit risk. That is where we will have audit risk, which is wrong audit opinion, issuing wrong audit opinion. To conclude this part, we would like to show the link between the assessment process of risk with the different type of risk, as well as with the quality of audit process and the audit opinion. So an effective auditor recognize the risk existed, which is the risk of inherent risk and control risk. This process is difficult to measure and require careful thought to respond. So if the auditor properly assess the existing risk, the inherent risk and control risk, then the auditor will be able to set up the acceptable audit risk, which we call the auditor may accept some lower level of audit risk in performing the audit risk, because we cannot avoid or absolutely minimize or delete the risk. Okay, and this one will respond to the risk that we probably is critical to achieve the quality of audit. So just to summarize or link the assessment of risk along with the quality audit. So this is the last slide in the part 3. We have the last part, or the part 4 will be discussing the details of the audit risk model, and we will also link it to the audit evidence. So see you in the next time, inshallah.